Immediately after the last Fed meeting where they decided not to cut rates, we got the BLS jobs report, which not only came in a big miss, it also had insanely huge negative job revisions for the last 2 months. They overestimated the jobs created in the prior 2 months by an unbelievable 88%. They said 286,000 jobs had been created, and it turns out it was actually only 33,000. How is that even possible? Then last month's job growth came in at just 73,000, with unemployment back up to 4.2%, and as a result, mortgage rates immediately dropped to 4-month lows. New listings are losing steam and inventory growth is slowing. Meanwhile, Dallas County just had its 3rd largest week of closings. We're covering all this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. Okay, today is August 4th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here to get to the latest weekly market update. Starting with market news. The July jobs report was a bad one, which is a good thing for mortgage rates. Job growth came in at just 73,000 jobs created, missing expectations. But the bigger news to me is those enormous negative revisions from the prior 2 months. These are the biggest negative revisions since COVID, and before that, we haven't seen negative revisions this big since 1973. The May and June jobs reports got revised down by 258,000 jobs. And as of now, the 3-month job creation average after those revisions is just 35,000 jobs a month. First of all, how does one overestimate by 258,000 jobs? For context, May they had originally said was 139,000 jobs, and now they're saying it was actually only 19,000 jobs. And June was 147,000. Now they're saying it was just 14,000. So of an estimated 286,000 jobs, 258,000 of them were just made up, from 286,000 down to just 33,000. How in the world does one miss by such a huge margin? Especially when it's the main source of data that the Fed is using to decide about rate cuts. What's the point of even having a report if it's nowhere near being accurate? If the Fed had gotten these numbers just a few weeks ago, for sure they would have cut rates. But nonetheless, mortgage rates came down anyway to 4-month lows, and that's because the Fed is just one component of mortgage rates. Think of the Fed as being really old and slow, and it's the bond market that can react quickly to this new data. So the bond market sees these revisions are horrible, there's obviously going to be a rate cut coming, so the bond market takes that data and reacts today, which is why mortgage rates came down now instead of having to wait for the Fed to cut. Now, if you'll remember way back in December, the Fed said their goals are to get inflation below 2% without unemployment going above 4.3%. And right now inflation is at 2.1%, so it's already almost there, and unemployment ticked up 0.1% back up to 4.2% right now. So in their eyes, everything is still working as intended, even with these negative job reports. But it's obvious now that even though the labor market hasn't broken just yet, it's getting much closer than we thought. And it's getting to the point where it's pretty obvious they're going to have to cut rates next time. But once again, by the time the Fed actually does cut rates, mortgage rates probably won't move because the bond market will have moved weeks ahead of time. So mortgage rates will already be lower before the Fed cuts rates. But let's look at some charts. So unemployment, we already said, is back up to 4.2. The last report with those crazy jobs numbers that didn't actually exist, unemployment came down to 4.1. We're back up to 4.2. We've been up here a lot. And remember, the threshold is 4.3. So all of this time, all we've needed is just to get up 0.2. If we could get to 4.4, we can know that the Fed is going to cut rates. But we are just stuck at 4.2. Next, residential construction. We've talked about this many times. Once home builders start laying off workers, it's usually an early sign of that a greater job loss recession is on the way. You can see it many times. Residential construction starts layoffs, then we hit a recession. Here again, you have all these layoffs, then the recession, all these layoffs, then the recession, and so on. So we've been talking about it for a long time because somehow we've managed to avoid mass layoffs even with rates super high for so long. But you can see right here, this is the biggest obvious decline that we've had. And this is important because there is no reason to believe that this number is going to even stay flat at this point, because new construction inventory is rising and they're pulling less and less permits. So as this backlog of homes being built right now finishes, they're going to have to start laying people off unless mortgage rates come down, because there's just not enough demand for the homes that are being built right now. So this will be an important one to watch in the coming months. If this continues down, we're going to be in trouble. Rates have to come down before these layoffs start to happen. Otherwise, that's a big indicator that a recession is going to hit. Then looking at jobless claims, this is the best leading indicator we have as far as unemployment is concerned, because this reports every week. I believe it's every Thursday. And you can see we had been trending up since January. We had higher lows and higher highs, which was showing us the labor market is getting softer and softer. Maybe we're headed toward rate cuts. And then all of a sudden, jobless claims just came straight down, which is good news if you're someone who wants to be employed, but bad news if you want lower mortgage rates, because when the Fed sees this, they can see it's not concerning at all. These are very low jobless claims numbers. So long story short, the labor market continues to soften without breaking, but today we all learned it's actually much softer than we previously thought. And if rates don't drop soon, things actually are going to start breaking. And that data has given the bond market confidence that a rate cut is probably coming in September, which has the 10-year dropping now, which has mortgage rates dropping now. Now moving on to my property showcase for the week. As many of you know, Richardson, Texas is one of my favorite markets here in the Dallas-Fort Worth metro. It's only 16 miles north of downtown Dallas, and there are a ton of Dallas millionaires moving up here to build their forever homes in neighborhoods just like this one. Because if you're willing to drive an extra 15 to 20 minutes, you're going to save $500,000 or more on a newer luxury home. This neighborhood is less than 5 minutes from Highway 75 or George Bush Tollway. It's got the Canyon Creek Country Club inside the neighborhood, the Prairie Creek Park, which actually has a waterfall inside it, and 3 top-rated elementary schools. Plus, you're just minutes from shops and restaurants like Barnes & Noble, Target, Mi Casina, Home Depot, Central Market, Whole Foods, and your neighborhood borders the University of Texas at Dallas. This home is 4,379 square feet. It has 4 bedrooms, 2 primary suites, 4.5 bathrooms, a massive office suite, game room, and is available for just $1.825 million. If you were to buy a home like this in the Lakewood neighborhood of Dallas, for example, you're looking at probably closer to $2.5 million, whereas this one is only $1.825. And most of the homes this nice in these neighborhoods are being built as forever homes and won't hit the market for a long time. So if you're looking for something like this, call me today, because you never know when your next opportunity at a home like this in a neighborhood like this will be. All right, let's move on, starting with national housing inventory. This week we had a small increase of just 5,194 homes for sale in the country. This keeps us right at 27% more inventory than we had last year, same as last week, to a total of 865,620 homes available for sale in the country. And this same week last year, inventory was only at 683,738. That's this huge jump here. So we're doing way better with inventory than last year, but we're still not back to a normal market. Then for reference, the inventory bottom of 2022, way down here, we only had 240,000 homes for sale. At the peak of last year, we had 739,000 homes for sale. Now looking at new listings, this week we had 1,684 less new listings than last week. That's this darker line right here, for a total of 69,837 new listings this week. And as you can see on this chart, we have started consistently lagging behind 2022, and this week we're actually also behind 2024. And in my opinion, sellers are starting to realize they can't get the price they thought they could. They're seeing more and more homes coming onto the market in their neighborhood, and they're seeing inventory sitting, having price cuts, and they're deciding to just stay put now. And that's not necessarily the best choice. There's no guarantee that if you wait a year or two, you're going to be able to get more, or it's going to get more competitive. But I think that's just the perception right now. People are seeing inventory has come on so fast, and they don't want to have to compete with that. But overall, new listings were doing really well at the beginning of the year, and now we're starting to lag behind, but at least it's given us some time for some inventory to stack up, because once rates finally do drop, we're going to need more inventory than we have now. Otherwise, prices are going to go up again. Now looking at pending sales. This week, we had 7,079 more homes pending than we did a year ago. We had a total of 386,561 homes under contract. You can see every year pending sales are growing and growing. Then looking at new contracts, that's weekly pending sales. We've had some good growth over the last few weeks. This week we decreased by 2,196, although that still leaves us with 2,200 more homes going under contract compared to a year ago, for a total of 68,413 new contracts. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we climbed just 0.1% this week, pretty flat. We're up to 41.7% of homes taking a price cut. As you can see, we have followed really closely to last year's trajectory, which means we're probably getting pretty close to the top. You can see it happened around here. It may have come up a little more after, but I would say we're pretty close to the top of percentage of homes having price cut. I don't think we're gonna hit as high as 2022 did. But just so you know, if you want prices to come down, this number needs to continue going up. So we could expect until probably somewhere around October, it's maybe gonna slightly continue up before it starts to come down. Now looking at mortgage rates, we started last week at a 6.81, and after that jobs report, we came all the way down to a 6.63. That's this big drop you can see right at the end of this, 6.75, and in a single day, all the way down to 6.63. And you can see the last time we were this low was all the way back, well, here, that was April 4th. So exactly 4 months ago since we've been this low. Then looking at mortgage purchase applications, this week we had a 6% decrease weekly, but that still puts us 17% above last year's numbers, because you can see we were declining here as well. So we're about the same percentage above a year ago as we were last week, which gives us 22 straight weeks of positive year-over-year growth. The reason that these are such dramatic numbers is because these are still record lows. Like, last year was an insanely low amount of mortgage demand. So 17% seems huge, but all you really need to know from this is it's more than last year. So home sales should be growing, and we see that in all of the data. We've had more sales, we have more pending sales, we have more weekly pending sales. And what this is showing you is that should continue. We're still consistently getting more people applying, especially with rates coming down last week. If that can continue through the rest of the year, then we're gonna keep seeing more and more sales happening this year. All right, now we're moving on to the local markets, starting with the MLS data of Dallas County. And this week we had 646 new listings, which is 89 more than last week. So you can see after 2 weeks of decent declines, we're back up to more normal. Outside of the skewed holiday weeks, yeah, we've got a lot of 680, 660, 640. So we're right in line with where we should be outside of the holiday skewing that happens. We had 364 closings, which is 67 more than last week. And it's also the third highest number that we've had all year long. And one of those was this 478, which was around a holiday. So if you get rid of that one, so if you were to average these two out, then this actually probably, so if you were to average these two out because of the holiday, then this is actually probably the second largest number of closings we've had in a single week this year. Then of the homes that closed, 55 were immediate sales, meaning they contracted within the first week. That's 4 more than last week. This week we had 326 new contracts, that's 29 more than last week. And that's more than we've been seeing for a lot of these weeks. We've been in the 200s for a while. So whatever's happening, more buyers are coming out. And in total, we have 2,149 homes either under contract or pending. That's 47 less than last week. Now moving on, the same thing, but for Collin County. This week we had 501 new listings. That's 11 more than last week, and 501 is a little lower than we've been seeing for Collin County. We had 338 closings, which is 37 more than last week. Of the homes closed, 38 were immediate sales. That's 3 less than last week. We had 202 new contracts, which is 2 less than last week, but still pretty consistent with where we've been in the low 200s. And in total, there are 1,932 homes either under contract or pending, and that's 71 less than last week. Now let's move on to the Market Action Index. If you've never seen this, it takes into account all this data, puts it into one easy to read graphic with a number. Everything at 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in, and we're currently at a 35, which is a slight seller's advantage. We've been there for a long time. And looking at the Market Action Index line, you can see we peaked at about 37.74 in May, and we've just been trending down slow and steady ever since. But looking at median list price, we have remained flat for 2 weeks now at about 420,000. Median price of new listings. It's clear it's been trending down. Right now, it's just been going a little more sideways, but overall the trend is down, and that's normal. That's what should be happening this time of year. Average days on market had an increase of 1 up to 95. So what you need to know is if you want to list your house in Dallas County, the average days right now are 95 and the median days are up to 63. And you can expect that number to go up as the year goes on. So if you were thinking you're getting multiple offers in the first week, that's not what's happening for most houses, not by a long shot. Homes having price decreases is continuing to go up just like nationally. Although inventory has been very flat. We're actually lower than we were 2 weeks ago. But overall, this is normal. What you're seeing is a cooling market, which should be happening now through the rest of the year. Then the same thing, but for Collin County. Collin County has consistently been cooler than Dallas County. It's a 33 slight seller's advantage, still a seller's market. And they've actually not really dropped over the last couple weeks, 33.3, 2, and 1.5. So very, very slow drops. They're holding pretty firm to that 33, but their median list price dropped 2 weeks ago and has remained flat at 545. Their median price of new listings actually bounced right back up towards been. So there was only 1 week where it kind of fell out of that range it's been in, and now it's right back up in it at about 520. Average days on market increased by 2. Median days has been flat at 56 for a couple weeks. Price decreases are looking pretty flat here, although they're quite a bit higher than Dallas County already, so that's not too unusual. Their inventory as well has been dropping. Yeah, 448 down to 425. So nationally, inventory is still going up, but in Dallas and Collin counties, it's actually gone down slightly. I guess you would just call that flat. Let's call it flat. But overall, nothing's unusual here. Things should be cooling off slowly and steadily. We're still in a slight seller's market, and that's what you need to know. Now moving on to our top 10 ranked charts, the hottest and coolest cities and zip codes in all of Dallas and Collin counties. These are ranked using that same market action index number we just looked at. Remember, 30 or below is a buyer's market. Starting with the hottest cities, the absolute hottest remains and has been for a long time, Grapevine, Texas at a 41.56. And then Lancaster heats up 2 this week. Carrollton remains at 3. Duncanville heats up 3. Coppell cools off 3. Grand Prairie remains. Richardson cools off 2. Garland remains. Irving jumps onto the list at number 9. Hutchins cools off 1. And then Louisville goes from number 10 last week, cooling completely off the list this week. And then we like to zoom in at specific zip codes. The absolute hottest is Irving, 75061, followed by Lancaster, 75134, Dallas, 75241, Grand Prairie, 75052, Carrollton, 75007, Grapevine, 76051, Richardson, 75082, Duncanville, 75116, Carrollton, 75010, and Dallas, 75253. So if you have a home in one of these zip codes, you should be able to get whatever top dollar is at this time. Now moving on to the coolest cities and zip codes, and everything below Royce City, all of these are officially buyer's markets on the city level. Starting with the absolute coolest, Leonard cools off 1 to a 28.11. Rockwall heats up 1. Van Alstyne and Blue Ridge remain. Sunnyvale cools off 2. Salina heats up 1. White Wright heats up 1. Royce City remains. Anna cools off 1, and Lavon heats up 1 to take the hottest city on the coolest cities list. Then looking at the coolest zip codes, all of these zip codes are officially buyer's markets. Starting with the coolest is Dallas, 75204 at a 26.97. Followed by Wilmer, 75172, Leonard, 75452, Rockwall, 75032, Rockwall, 75087, Irving, 75038, Dallas, 75254, Van Alstyne, 75495, Blue Ridge, 75424, and Sunnyvale, 75182. As always, if you're looking to buy, sell, or invest here in the Dallas-Fort Worth market, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.